I mean, I remember at the start of last year, my forecast for 2024 was 2024. We're going to see 2% real economic growth, zero recessions, inflation's going to come down to 2%, unemployment would stay at about 4%. And honestly, if we didn't have policy implications and policy changes in 2025, I'd be awfully tempted to use 2024 as my forecast for 2025.
This podcast is for advisor use only and not to be distributed to the public. The Wealth Consulting Group is an SEC registered investment advisor, and the opinions voiced and contents in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. The economic forecasts set forth in this material may not develop as predicted, and there can be no guarantee that strategies promoted will be successful.
Okay, welcome everybody to the 15th episode of the Bull of Wall Street podcast. With me are my co-hosts, Tally Leger, our Chief Market Strategist, and Jim Warden, our CIO. And today we have Dr. David Kelly, one of our favorite economists over the many years that all of us have been in the business. And so we're very grateful to have you join us today, Dr. Kelly. And I'm going to let our market experts ask you a lot of questions because they're the experts on our team. And I'm Jimmy Lee. I'm the CEO of the firm, and I'm also a financial advisor. So I've seen you speak at many conferences over the years, and I've just always been a big fan. And I know that you're a huge fan favorite amongst financial advisors. So, and this podcast is intended primarily for advisors. And so, again, we can talk about the different views that you have about the markets, but anything that you want to chat about is good with us. And I'd love to ask you,
Yes,
just kind of your career. You've had an incredible career over the years. And again, I've seen you on stage at many conferences in the past, and so maybe just kind of getting the viewers that don't know you as well as we do a little bit of background of how you've gotten to where you are today.
Well, thanks, Jimmy. And first of all, I really appreciate being on this podcast. Yeah, it's been a long and winding road. I started off in Ireland. I went to college in Dublin, but then also Michigan State. Married a girl from Grand Rapids, Michigan. Moved out east, and really, I'm an economist, and that's really what I am at my core. But obviously, I had to put food on the table, so I decided I was going to be an economist with investment implications. And so I've really been looking at the U.S. economy in particular, but the global economy, global financial markets for many years. Worked at a number of firms that are actually no longer existing. I hope I wasn't too much of an albatross for all of them, but I've been with J.P. Morgan now since 2008. And I lead the Global Market Insight Strategy team. And what we really focus on is we do a lot of research, and I love doing all the research with my colleagues, both within the team and throughout the firm. But what we try and focus on is making the point clear. We think there's a big vacuum in Wall Street where there are too many people who are trying to prove how smart they are or loft the ball over investors' heads. And we do the research, but we want to see in the way we illustrate something, in the way we talk about something, in the way we think about something, the way we organize our thoughts. How can we make this useful and clear to investors and to financial advisors and investment professionals, so it can actually be useful to them as they make investment decisions?
Well, that's great. And that's one of the things I've always appreciated about listening to you talk, whether it's on TV or in meetings or whatever, is that you do make a lot of sense to the common investor. I think, that's not just the CFAs out there. So I think everybody appreciates that. And especially advisors, when we have people like you speaking at our conferences to our clients and advisors. With that, I'm going to turn it over to Jim to ask our first question about the markets and economy. Go ahead, Jim.
Yeah, so happy to have you with us, David. I know I first heard you speak, I think it was 2009 when you just moved over.
Wow.
And it's amazing. JP Morgan, like the JP Morgan asset management has grown so big. So I'm super happy for that journey that you've been on. So I guess kicking it off, you mentioned prior to us starting talking about like geopolitics and the economy and what's going on. Like, what concerns you the most, and what excites you the most about kind of where we're at right now?
Well, oddly enough, what concerns me the most is nothing to do with the economy and nothing to do with markets. It's got everything to do with how investors are positioned. The What we've seen is we've seen some great years for markets. We've seen U.S. equity markets in particular just soar, and in particular the sort of mega cap growth stocks within U.S. markets. But a lot of people have been investing passively in this. A lot of people have got capital gains exposure if they sell stuff or rebalance. And so investors have gotten more and more concentrated in areas that are more and more expensive. And I worry about individual investors who end up with just the wrong allocation. And you never. I always say you never know the hour or the day when a bear market is going to occur, but you do know where it is going to occur. It always or is worst in the area that was most bubbly beforehand. And I'm just afraid that a lot of people are overweight the overhyped at this stage. And that's where the danger is. There are issues. I think that, the second thing I'd say is I think there are issues about valuations and the concentration markets in general. And then, the U.S. economy is very good, but it's very resilient. It can take a licking and keep on ticking. But I think we are, to some extent, abusing it in terms of the number of policy levers we're pulling here and the way we're trying to manipulate it. And there is a danger that enough bad policies out of Washington could disrupt what has been a very stable economy to this point.
Callie, go ahead.
Yeah, go ahead, Tally.
Yeah. Well, first of all, David, nice to see you.
Yeah, I see it, Tally.
When I saw your name on the schedule, I thought to myself, well, what a nice surprise. We haven't spoken in a while, so this is a good catch up. You were talking about the economy right there, so maybe I'll kind of ask you a two-parter. One of the first questions that I like to ask when we're setting investment policy, because it's such a big, important question, is where are we in the business cycle? So what is your take? Are we early, mid, or late?
Well, I think my take is that we're post-cycle. And what I mean by that is, let me be clear before I go any further. I don't think that means we're invulnerable to recession. We are vulnerable to recession, but we're vulnerable to recession because something external goes wrong in the economy rather than the workings of the economy itself. I honestly think the old business cycle model, which I was taught, and looked at recession since World War II, the ones that we've got the data on. And it's pretty standard. You've got solid economic growth, then it's strong economic growth, then it's exuberant economic growth. But the problem is that inflation bubbles up. When inflation bubbles up, the Federal Reserve feels like it has to raise interest rates to slow down the economy, to kill inflation. Well, they do manage to kill inflation. The problem is they don't just slow down the economy, they put it into recession. You end up in a recession that does kill the inflation. But then you have to sort of pull yourself out of that. And that's kind of how the business cycle works. But the last time around, we sort of played out Act 1, Act 2. After the pandemic, we got this big surge in economic growth and inflation did go up, actually by the most we've seen since the early 1980s. And the Fed did raise interest rates to try and curtail that. Funny thing is that inflation came down of its own accord, but economic growth really didn't turn south in any meaningful way. And so the economy was still growing about 2.5% year over year last year, despite the effect of higher Fed interest rates. And meanwhile, inflation was coming down to 2%. And I think that's kind of where we are. I mean, people talked about a soft landing. The truth is, we landed a while ago. It's kind of like, I don't know if you've ever flown into Chicago O'Hare, but you can land on Chicago O'Hare, and it'll still half an hour before you get to the gate, it seems, because it's just so much taxiing to do. So we've been taxiing after landing for some time. And we could actually do this kind of indefinitely. I mean, I remember at the start of last year, my forecast for 2024 was 2024. We're going to see 2% real economic growth, zero recessions, inflation's going to come down to 2%, unemployment would stay at about 4%. And honestly, if we didn't have policy implications and policy changes in 2025, I'd be awfully tempted to use 2024 as my forecast for 2025. I mean, the economy is capable of about 2% growth. There's no reason for a recession. You could get inflation to come make the rest of its journey down to 2%, and you could stay at 4% unemployment. So that's where I think we are. I think we're in a sort of post-cycle environment. But the real question is, slower economic growth, the economy is vulnerable to shocks. We've had plenty of shocks in the 21st century already. Will we have some more?
Right. That's actually a great tie-in to my second question, and then we'll kick it to another co-host here. But I agree. It certainly feels like a 2% economy now. But how could that change? And your latest weekly, actually, I saw the title and I thought it was a nice way. I didn't dig into it, but it was kind of a nice way to frame the discussion, the implications of slowing population growth. And as we know, growth in an economy is driven by two key concepts, the population and the productivity of the population. So given all this AI, tech investment, spending, CapEx, what's the outlook? Is there any hope that we could see kind of some offset on the productivity side of that growth equation?
Yeah, so I put out this podcast, Notes in the Week Ahead, every week, and then I also put it out as an article on LinkedIn. And this week I was talking about the fact that, as far as we can tell, for the first time, I suppose, ever, U.S. births are likely to fall below deaths within the next decade, and so we're going to have a declining natural rate of population growth. And the only thing that's going to cause the population to grow would be immigration. Now, of course, we had massive immigration the last few years, but we've seen such a 180 in terms of U.S. immigration policy that you could, if you had enough deportations, end up with zero immigration net. And if you had that, then not only does the population stop growing, but the interesting thing is we've got a particular problem with the working age group, because a lot of the U.S. population, we have a big chunk of baby boomers who turn 65 or turning 65 still and falling out of the labor force. But if you look at the population age 18 to 64, without any immigration, if you had zero immigration, that cohort would be falling by 700,000 to 800,000 people per year. And so you'd have shrinking labor force growth, and that does slow economic growth. As you said, Tally, economic growth from the supply side is just the growth in the number of workers and the growth in the output per worker or productivity. I do think that the world, the planet, has to get used to the idea of zero population growth. You can't just keep on increasing the numbers of billions of people on this planet. It's not healthy for anybody. So I think the world needs to get used to zero population growth, and perhaps zero labor force growth in the long run too. But yes, I think capital spending can absolutely help on AI robotics. I think you'll see that. So I think we have the technology. Or we're building the technology. I think we have the capability. I think most of the problems that we face are really problems of political problems, policy problems. But I see tremendous potential in AI, particularly if you marry AI with robotics. I mean, every day as you see a story in the news, I think I saw a robot filling pharmacy prescriptions, and they had one of them was called I don't know, was Dr. Mix-a-Lot or something was the name they gave the robot. It was kind of cool. But you can see when you watch these robots doing that, and you think, boy, we're awfully close to the point where robots can flip all the burgers and bring them to the front of the counter. Right. Robots can drive all the cars. Robots can do all the lawn maintenance. Robots can do more of the construction. You have to get the instructions right. You've got to have the certain flexibilities. But you can see how if businesses are forced to economize in labor, there are ways of using technology and robotics to substitute for that. So that is all possible. It's really not our capabilities or our ingenuity that I worry about. It's more sort of, will we make some political mistakes along the way, or geopolitical mistakes along the way that prevent this from happening?
Well, let's hope that the robots can't write financial market strategy anytime soon. Well, I know Jimmy wants to buy one.
Well, what I've seen in the only thing that gives me a little hope is so far what I've seen out of various large language models is they can absolutely summarize stuff, but they're boring. And so if we can figure out an AI way so that AI can read the stuff that AI writes and cut us out altogether, then we'll be fine. But at the moment, I think that most people don't like reading the stuff that AI writes. But that could change.
Yeah, I've been talking about buying one of these humanoids. You can buy for around 20,000 retail today, and to see if you could program it to replace us as advisors. 2 years ago, I went to one of your meetings in New York, and I'm a big fan of Jamie Dimon, and I wanted to hear you and him talk. And he said to the crowd that he doesn't think financial advisor business will ever go away because, you have human nature, right? People always panic and make the bad decisions that they always do if they're investing in their money. That being said, I want to ask you a question that might be a little bit more controversial. Mm-hmm. And I was listening to another podcast, and they played something. I think some interview, or Mr. Jamie was talking to somebody about bringing everybody back to work. Yeah. And as an economist, and maybe both you and Tally can riff about this a little bit. As a CEO of a much, much, much smaller company, I wonder about that. My general bias is that most people need structure. Now, certain jobs, I think, and roles and people can be very effective working from home. I mean, the four of us look like we are right now. And I was working from home prior to COVID. That being said, I wonder from a productivity standpoint, what you think about that? And then, Talia, maybe you can jump in and kind of, you guys are economists, and then Jim can chime in too. But what do you think, Doc?
Well, I think that I think it really depends on the person and the job. I think you're quite right. I can work from home. In fact, I think that for my group overall, we were at our most productive over the pandemic because we could do things like this. And in fact, it's kind of like a war. Sometimes technologies emerge from wars, which it cause a bump in productivity. And frankly, for years, I've been wishing that various boards of, various financial advisors and so forth would just all get on some sort of telepresence so we could just do these teleconference calls and wouldn't have to fly somewhere. Now, of course, if you're talking to 300 or 400 people in a conference, then you want to be there in person. I get that. It's a matter of respect. It's a matter of just the touch and the feel of the thing. But a lot of information in financial markets, a lot of meetings with clients can really be done with this technology and working from home without the distraction of people shoving by you and telling you the latest joke they heard. I find it actually more effective. But I think that we are somewhat biased in our view because we're thinking of it from a sort of more senior, we've been at this for a while perspective. I do see our younger members of my team. I think they really do benefit from being in the office. And we've got a little corridor where they all sit in the office, and they're all they feel like they're part of a community, part of a work community. And I actually think in people's human lives, that human interaction that comes with work is actually very important. I don't think it's so important for idea generation. I think it's important for morale. I think people feel like they're all part of something. And so I really agree with the spirit of what Jamie's saying, so long as it's got a degree of flexibility in it for people who are flying off, coming in on a red eye, who really do need to actually take it just a little bit easy for a few hours before they get back to work. But I've always found JP Morgan is very flexible. I know the messaging he's sending. I completely understand why he's saying that. But I will say that for the people on my team, for the most part, we've tried to be flexible, and that hasn't hurt us over the years.
Tally, what do you think about that? I mean, literally from like an economist viewpoint, have you thought about it from productivity standpoint?
Well, I agree with David's comments about the younger cohorts who might need, more shaping and molding and guiding. And I guess in a similar vein, if you're looking for promotion in your early career, you got to have FaceTime. You got to be connecting with the right people and all that good stuff. And I think that's right. And of course, personally, I'll speak for myself. I enjoy having conversations with my colleagues and who are also my friends. But I guess it's situational, right? It also depends where you are in your career. I travel a lot for my job, and so I can't actually be in the office all the time. And it's kind of a balancing act. I need office time because that's when, like David said earlier, I need to be thoughtful and introspective and look at the data and do some research and write a report. But then I got to get out there and tell the story. I can't be stuck in the broom closet all the time. And I don't want to be out there selling all the time either. That's not productive because I have to go back and do some work. So for me personally, it's a balancing act.
Yeah, I think we'll have to have flexibility in this because the other thing that I think has happened is we've got a lot of younger families where you've got two people working and they've got daycare issues and they've got transportation issues. And it's, I think every business as a sort of a more a middle management level has to be a little bit flexible here and try and figure out for each individual worker, can we find some way to make this work? So as I say, I think it's a good rule in general to try and get people together. I don't think that we're a particularly representative bunch actually talking about this.
No.
I do think that ultimately humans can be productive in lots of different places. Personally, I get up at 5 o'clock every morning, and I do all my good work is done before 8 a.m. and then it's just sort of meetings and stuff. But that's when I do my writing.
Yeah. Well, you're always working. I'm seeing you on TV and other things all the time. Jim, before you ask the next question, I just want to ask Dr. Kelly one thing about inflation. It sounds like my personal opinion has been that I think inflation is going to be coming down, and that the Fed should move faster to avoid economic problems. And we're starting to see some layoffs being announced. I'm not sure if necessarily if that's cyclical or if that's because the economy really is slowing down. What do you think about inflation? Where do you think we end up? What do you think the Fed ends up doing this year in terms of rates?
Well, I think on inflation, if there weren't any policy changes, I think inflation would come down. I think it's actually been quite easy to model because you had temporary inflation. It was temporary. I know the prices went up and everybody got really, hot under the collar about it. But we had temporary inflation in energy, in core goods, supply chain issues and so forth. And then that kind of went away. The prices remained high and they're not coming down, but the inflation went away. And so what you're left with is inflation in shelter, in auto insurance, and even in some services areas where there's a bit of wage inflation. But overall, it's trending towards 2%. If nothing else happened, we'd hit 2% over the course of this year, as measured by the consumption deflator. But I have to say that, if you do increase tariffs, you're going to push up some prices. If you're tough enough in immigration, you're going to run into a labor shortage, which could push up prices also. And I think that those two things mean that inflation's probably not going to come down quite as fast as, to 2% that quickly. Equally, I don't yet see enough of a slowdown in the overall economy to warrant the Fed moving earlier. I think that they're okay waiting a little bit here, but it's really a matter of policy. I mean, we've got a lot of questions coming up this year about how much will we end up with in terms of tariff increases? How strict will immigration enforcement be beyond deporting people who've actually committed crimes other than being unauthorized immigrants? And then how much fiscal stimulus will be embedded in the 2025 tax bill or tax bills that will go through Congress? The Fed needs answers to all of this. And I kind of agree with Chairman Powell's view, which he expressed 2 days after the election, which is we don't assume, we don't speculate, and we're just going to wait until we see what actually happens in these policy before we react to them. So I think the Fed's okay waiting a little bit here, but I would like some clarity on these issues. I think the Fed would like some clarity on these issues from the other side of Washington, so they know how to think about the economy and inflation in that context.
What do you think about Doge? Do you think that's going to have there's reports saying that it's the biggest layoff ever. And do you think that's going to have a rippling effect throughout the economy and as far as employment goes?
There'll be some impact. There are 3 million federal employees. It's just under 2% of the total workforce is civilian workforce is in the federal government. And we know that 77,000 people took the buyout, but they actually stay on the government's payrolls through September. Then they'll fall off in October, but presumably they're all busy scurrying around trying to get other jobs right now. The layoffs themselves, so far, I have not seen good numbers on aggregate on how many layoffs there are. You hear about thousands this agency and thousands that agency. I think it's going to continue. So maybe you do end up with 100,000 layoffs or 120,000 layoffs, which might be the biggest single entity laying off workers. But, in an economy where we regularly add 150 to 200,000 jobs per month, it's still not that massive. I mean, it might be worth a month's worth of employment growth. So I do think that the actual federal layoffs themselves are probably not enough to cause a recession or ripple through the economy. Now, there are other parts of this, though. One part of this, which I think is very important, is to what extent do the other activities of Doge or the other activities of the administration slow or stall out or prevent the distribution of grants and aid and contracts around the economy. There are a lot of there are a lot of, say, biotech firms or universities who receive government money through the National Institutes of Health, or they don't know if the money's coming, or and there's a long list of people who, one way or the other, depend upon the federal government. And the federal government is not dependable. They may hold off hiring people. And so I worry about, I'll be looking very closely, not just at layoffs, but also at, well, what's the pace of hiring here? Or will a lot of companies like the Federal Reserve decide that they are not going to speculate and they're not going to assume, and they're just going to see how this all plays out? And if that's the case, then you could get more weakness in the job numbers. So we're watching this very closely.
Jim, go ahead.
Yeah. So Dr. Kelly, just along the same lines, discussing the economy, particularly the consumer. So we've seen some weakness with retail sales. We've seen consumer sentiment come down. There's a lot of money in cash right now. Some people would look at that as a good thing, that, you can spend that, you can invest that, but it feels like there might be a little bit of consumer angst. Mm-hmm. How sensitive do you think the economy is to changes with what the consumer's doing? I mean, I feel like there's two consumers too. There's the very wealthy consumer that owns assets, and then there's the consumers that don't. So,
well, that's absolutely the case. The economy is divided sort of four quadrants. It's divided Democrat, Republican. It's divided rich and poor. And generally speaking, after the election, as has been the case in the last few elections, as soon as the election was over, one side got very happy and the other side got very sad. Yeah. And you can see that in all the data. I mean, actually, it's very troubling if you think about the biased information flow that people are receiving, because the expectations, for example, on inflation are completely divergent depending upon whether you're a Republican or a Democrat, which suggests that people are just listening on both sides, are listening to misleading news feeds. But I think that that's one issue. And then you're quite right. Richer Americans have been doing very well. These huge increases in wealth. When I started this business, wealth effects weren't that big. But wealth has grown so much relative to the size of the economy that, last year we added $15 trillion in household wealth. The year before we added $11 trillion in household wealth. Wow. These are big numbers, and they're enough to push spending. And so where you see the spending is, high-end restaurants, vacations, airline tickets, ball games. There's a lot of spending at the top, but you're also seeing the sort of great mass of lower middle income consumers. They are getting squeezed. I think they're getting squeezed by demographics, for one thing, because I think the immigration surge, or the immigration crackdown, is actually having an impact on the number of new consumers in the economy. But also they're being squeezed in terms of income. They're not that far ahead, and so they feel pretty gloomy. So I think that's also slowing consumer spending a bit. But overall, I still don't see anything that gives me a negative or even a 1 on real GDP growth. I still think we're tracking close to 1.5 to 2%.
How about the wealth transfer between baby boomers and Gen X and millennials? Does that change much? What happens with the economy?
That's a really interesting question. And I'm beginning to think that the answer is, oddly enough, no. And the reason I think the answer is, oddly enough, no, is that the way it works is, if you're in reasonable health in this country and you make it to age 65, you have a good chance of making it to age 85 or 90. And by the time that money gets transferred, it gets transferred to the kids. You know what? It gets transferred from old parents to actually old kids. And they're not going to spend right. I mean, if the wealth transfer is a whole pile of 90-year-olds giving a whole pile of money to a whole pile of 60-year-olds, nothing's going to get spent. Maybe if you really want to boost the economy, what you have to say is, well, we will give you a special tax break from if you'll cut out your children and just give it to your grandchildren,
grandkids. That's interesting.
So, by the way, I'm glad to see that I'm the only one not wearing a blue blazer and a white collared shirt.
Yeah, exactly. It's like
Which one is different?
like one of those Sesame Street songs. One of us is not like the other.
David, Callie was the epitome of an amazing, great Italian suit, and all of a sudden we start this podcast, and his French Canadian comes out. He had a birthday last week. He was out skiing.
Oh,
I
Yeah.
saw some great pictures, but
I literally look like I came out of a French chalet, which is kind of close to the truth. But I had something. We were told that we have to be more entertaining, so that was pretty good, and I'll try and
yes.
keep it going. So, if you don't mind, I'd like to dig into the inflation concept a little bit more. And David, I've always appreciated your storytelling ability. We were talking about that earlier. And we don't have much as economists and strategists, but words and stories, and I think you help make some pretty dry economic concepts more accessible and entertaining for everyday investors and advisors. We try to do the same thing a little bit, but I saw a recent clip of yours where you were describing. I thought this was great. You were describing your wife's fresh cookies, hot out of the oven, and you used that as kind of an on-ramp or analogy for the latest inflation report. So I agree with your general view, inflation not prices, but the rate of inflation kind of coming down. But I wanted to kind of play the devil's advocate side a bit, just for the sake of the broader audience. So January's CPI print did come in on the hotter side, like your wife's cookies. And I also note that the 5-year break-even rate has been going up. I think it's like 2.6% or so. Should we be concerned about those recent increases in market-based inflation expectations, or do these kind of one-off seasonal effects kind of argue that prices should cool in February and beyond?
Well, there's a lot in that question. So first of all, let me explain about my wife's cookies. I love running, and that's kind of what I do to sort of deal with tension and everything else. So, but often I come back in from a long run, and I walk into the house, and the moment I walk in, my wife has got this knack of timing this. So she pulls the cookies out of the oven, these lovely chocolate chip cookies, and they're wonderful. She's a great cook, but they're also way too hot, and they are cooling, but they are cooling slowly. And it is extremely frustrating just waiting until these cookies are cool enough to consume. And it's a little bit like inflation. I mean, inflation has been cooling really since it peaked in June of 2022. And, that's almost 3 years ago.
Mm-hmm.
But it's just been cooling slowly. And that I think has been frustrating to people. But I still think that barring, if we leave out policy issues and come back to those policy issues, it will still cool. I mean, it cools for the two ways of looking at this. One, you can look at it just the way the government measures it. And the government mismeasures both rental inflation, which feeds through to what's called owner's equivalent rent. And together, those are more than a third of inflation. And they've been overstating this for a long time because they're not looking at market rents, they're looking at sort of a longer term series of how average lease rates have been changing over time. But we know that's going to come down. It's going to continue to come down. And also similar thing with auto insurance. They tend to look at all the insurance policies on a company's book rather than the new ones that are being written. And we've had a high degree of confidence that those two big areas of inflation were going to come down, and those was going to drag the inflation rate down to 2%. I don't really see any reason to back off from that. Then you have occasional surges in inflation, and you did get some of that in January. But if you look at what went up in January, what went up in January were airline fares, hotel stays. I think we got an increase in new vehicle prices, and you kind of look at that and you say, wait, is that not the spending the rich again? And then you've got some seasonal factors. So I do think that there's a little bit of that going on. Now, but having said that will bounce around. I do think that the long-term trend in US inflation, which was established really from the 1980s all the way to 2019, is still in place. If you don't mess with the economy, the inflation rate will tend to trend downwards. And I think there are three big reasons. One, technology makes more and more things just competitive markets, because with one click of a mouse, I can find a cheaper price. that is tremendously powerful for buyers in the economy. Two, we've had tremendous decline in trade unions. Only 6% of the private sector is in a union. And that means wage growth has been coming down very steadily despite a very tight labor market. And then three, we've got this income inequality. And the thing about income inequality is the rich are different. They buy assets rather than goods and services, or they spend more of their money in assets rather than goods and services. And so as income has become less and less equal across around society, more of the income generated in the economy has been going to buy stocks and bonds rather than goods and services. And that's actually tended to starve goods and services of demand and push inflation down. Those three big forces are still in place. And I still believe that they'll be in place. But you can offset that. If you have massive fiscal stimulus like we did in the pandemic, if you give a lot of extra money to lower and middle income households, they'll spend it. And equally, if we get more fiscal stimulus out of the 2025 tax bill or tax bills, that could push up inflation. Tariffs push up inflation. If you get a tight enough labor market, maybe you do get some wage increases. If you just cannot find people to do basic jobs, you're going to have a labor shortage. I mean, remember that one of the things about immigration is immigrants are much more important for the labor force than for the overall population because they tend to immigrate in their working years. If you reduce immigration, you're going to hurt supply more than demand. And so that could also tend to push up inflation. So I do think you could get some temporary inflation from these policies if they fall to, if they extend out to sort of extreme levels. But I still think that's fundamentally temporary. I think, politics moves in cycles too. And ultimately, I don't think this is an inflation-prone economy.
I've been saying that for a couple of years. I follow Dr. Jeremy Siegel's research as well, and he's been talking about how the BLS counts housing, your shelter costs, right, which is such a huge part of that core number. Yep. And we know that it's in arrears, and so that's why I also think that the inflation number is going to come down. I'm more worried about growth, and that's why I want to have rates come down, and maybe because I'm a financial advisor, I like to see asset prices go up. That being said, I want to ask you more of a question you brought up that you guys have been talking about the rich and the poor, or the two. What would you do as an economist to solve that situation to where there's not such a disparity between the populations?
That is an interesting question. All right, well, I'll take off my JP Morgan hat and my financial industry hat. There are a few things. First of all, I probably try to push for a higher minimum wage across the country. I think there's a lot of poor, lower wage workers, particularly in the middle of the country, have been sold a bill of goods. They're told that if you push up wages, you're going to have to lay off workers. But almost all of these workers work in the service sector. And as service sector workers, you're going to need them anyway. And so the employment impact of raising wages for the lowest minimum wages for these lowest waged workers really is negligible. I think that's one thing. I think another thing I would do is I think we've got a psychology in this country whereby we don't talk about money, and that really helps the rich. We have elections which are focused on cultural issues. And the last election was very focused on cultural issues. We sort of talk about immigration, or we talk about transgender rights, or we talk about all these things. When the really big issue, I'm no fan of Bernie Sanders' economics. I think he's wrong in so many ways in terms of how to run the economy. But I do think he's right in his confusion as to why we're so focused on cultural issues when we've got such a massive income divide in this country. If this country were focused on how do you reduce the gap between the rich and poor, then people would be up in arms over, they would about tax rates. They'd say, well, we need to reduce payroll taxes. We need to increase inheritance taxes. You've got massive, we're just talking about money being transferred from generations. Well, that is an extraordinarily generous system that we have in this country in terms of how much you can transfer without being taxed on that intergenerational transfer. So there are things you could do. Ultimately, it is also a matter of education. I think we need to encourage people to look around for education. I believe in educational vouchers. I believe in in people being free to choose the best education for their kids. I think we need to think a lot about family structures. A lot of these questions are not, why are the rich rich? They're why are the poor poor? What do we do in this country to allow, to encourage, make it so that poor people stay poor? I mean, there are a lot of scams, things like cryptocurrencies and lotteries and all sorts of things that we tell people, oh, this is how you make money. That's not how you make money. And I think, the things we need to do in terms of helping the structure of society at the bottom. It's a very long question, but
Yeah.
but I think I think a lot could be done, but there's a lot in society which really prevents it from being done.
Thank you.
So, Dave, I've got a question,
Yeah.
a little bit related to that, but like it's been said by several economists and market strategists that we are such a service-oriented economy
Mm-hmm.
that the length and the depth of our recessions are just not what they were. When we have a recession, it has to be like something major, like
Yep.
like global financial crisis. Now that we're bringing some manufacturing back, and I don't know, maybe this takes 10, 20 years. Do we get back to being a little bit more vulnerable if we do more manufacturing?
I don't really think so. I mean, I think that let's talk about, we started out by talking about this being us being in a post-cyclical environment. But I think a really interesting question is, well, why didn't we have a cycle? Why didn't we end up in recession in 2023? I think the reason is because the economy is less vulnerable to interest rates. And one of the reasons for that is manufacturing is a smaller part of the economy. Construction is a smaller part of the economy. But I think they'll stay that way. First of all, we've got less population growth, as I mentioned earlier on, going forward. So we're not going to have to build that many houses to start with. But also in manufacturing, a lot of the problem traditionally, you go back to the 50s and 60s, was actually about inventories. Companies simply couldn't figure out how much to make. And that gave you an inventory cycle. So what would happen is, GM would keep on producing vehicles until they were stacked 10 high in the parking lot outside the window. And it's only then they realized, oh, I guess we made too many cars. Then they'd slam the brakes in production, lay off a whole pile of workers. They'd stop spending at the stores. They'd lay off a whole pile of workers. And so you plunged into recession. That doesn't happen anymore. I mean, inventories is the most boring subject in economics because it's always kind of about right. And so that has reduced the cyclicality of the economy. And the growth in the service sector has too. But even if manufacturing grew as a share of the economy, I don't think it would make this economy that much more cyclical, because the really dangerous part of that was the inventory cycle. And by the way, I don't think with the dollar where it is, it's dollar is still very high. I don't think manufacturing is going to revive in a big way in this country, because, I mean, also with trade policy, I mean, it's one thing to say, yes, we're restricting imports, but global manufacturing works on a global basis. You need to export around the world. So why would you center a global manufacturing operation in the United States if you thought that every other country in the world was going to put tariffs on you in retaliation of the tariffs you just put on them? Particularly when you've already got a high dollar, which is causing us to have a $1 trillion trade deficit. So I would fade the whole concept of a massive manufacturing revival in this country anyway.
Interesting. How about with AI and data centers? And, there's some concern about, do we overbuild? We hear these massive plans. Apple just announced 500 billion. You've got the Stargate. Does that concern you at all? Or is this just, lots of cash that they have that over time it's going to be value additive?
Well, in general, I'm in favor of it. I've got one caveat I'll come to, but overall, the spending itself in AI, just go for it. I mean, you end up with a lot of bad ideas, but you end up with a few good ideas. And the truth is, you can't tell at the start what are the good ideas and what are the bad ideas. And it reminds me a lot of the dot-com bubble. We had a plethora of stupid concepts, but nevertheless, the internet definitely changed the world. There's no doubt about it.
Yeah.
And AI can change the world too. I think we'll find that, I often find that when we look at processes that we use for producing, say, the daily guide to the markets, which we now updated every day by 10 a.m. I remember trying to talk to the analysts about it and trying to work with the analysts and our data teams and, well, how are we going to do this? And they came up with all sorts of expensive solutions. And we found some simple programming solutions, managed to just do it all and save massive amounts of dollars that we could have spent on this if we'd tried to do it the expensive way. There are cheaper ways of doing this. I think you saw that with DeepSeek.
Yeah.
And I think we'll probably find that too with AI. There are many things that we're probably over-investing in, overthinking, not finding the simple solution. But the whole effort to try to do that is productivity enhancing anyway. So, and I think for an investor, don't be so sure you figured out the winners and the losers here, but do recognize that AI is going to change the world. So, think about a world, try to invest collectively somehow in that theme. I do, though, have one significant worry about the whole thing, which is it needs regulation. And we've got sort of this bumper sticker idea here. Well, all deregulation is good. I'm not so sure that all deregulation is good, because we live in a world of increasing complexity and technology complexity and power, power within technology. And if you think about the things that have actually caused recessions or caused market crashes in the 21st century, 9/11, a failure of regulating our airline system so people not, anybody could become a pilot or hop onto a plane with box cutters. I mean, just horrendous. The great financial crisis, a failure to regulate the mortgage market. The pandemic, a failure to regulate over in China, thousands of miles away, a failure to regulate individual scientists who are messing around with viruses. We have, technology gets ever more powerful, ever more complicated. And if we approach this with the idea that, oh, it's a free for all, just let it go, we're going to be in trouble. And I think that's true with AI also. I hate the idea that somebody in a basement someday is going to decide, well, let's just send out a rogue AI protocol here to shut off all the electricity and save the planet, or it has military uses, or I think we're seeing this already, whereby it feeds information, or various information technology systems feed information to particular populations to make them believe certain things and basically manipulate them, and the functioning democracies become obsolete. So there are many, many problems here that AI could create. It's one of a general group of technologies and technology improvements which cry out for some regulation. I'm just worried that we will be dangerously exposing ourselves if we simply approach AI with the idea, well, let's just deregulate everything, as we have done with many other things to our cost so far this century.
Interesting.
We're kind of transitioning into markets, which I think is nice. So maybe I'll ask a related question. So, look, we've got a 2% economy. We're on the same page there. It looks like inflation's trending down to the Fed's target. Feels like a pretty nice environment to be involved in stocks. What do you think? And I hear you, risks are concentrated in the Magnificent Seven, but what about the 493 and mid caps and small caps?
Absolutely.
And also international too. I mean, is this a head fake we're seeing, or is it real? And there's a lot of technical people that are very bullish on China at the moment.
Well, I think both of those. I mean, I would say, the beauty of this concentration issue and the valuation issue is that means there are a lot of opportunities out there which are not overpriced. And it's rare with the overall market being the overall US equity market being this high, that I could feel so good about value stocks in the United States, or the 493, or international equities. And I do. I think people should, to the extent they can do so without exposing themselves to more and more taxes. I think I think everybody needs to have a tax strategy here to try to be efficient with regard to taxes. But I think simply taking advantage of the broad global equity markets and all the opportunities in it, the right thing to do. With regard to international, the China, I must say, I know it's been rising, and part of that is the DeepSeek thing, and China has been very weak. I still think China is suffering from a massive lack of confidence within China. And I think President Xi and the Chinese government have to think about how do they fix that. And it's not going to be easy. And I think a lot of the problems stem from that. So I'm not willing to blow the all clear on China, but I think international equities in general, and China might be part of that, do make sense. And we saw some elections in Europe over the weekend, and we saw elections in Germany. And because of the elections in Germany, there's now going to be a government of the center-right party and the center-left party, without having to have a very fiscally conservative or overly fiscally conservative right-wing party, or an overly, environmentally conscious Green Party, which was really restraining Germany's energy and manufacturing side. So really, we got a very good result out of that. I think this could mean that the German economy overall, I mean, I think they're going to build up their military infrastructure. I think they're going to spend some money that could help Europe move forward. And Europe is. I wrote something on, and it was on my podcast. I wrote something on this a few weeks ago. Europe is like this train, always gathering steam in the station, but never seeming to take to actually leave the station. But I think with lower rates, I think you're going to get from the ECB, with plenty of consumer savings, and now with some fiscal stimulus, I think coming out of Germany, I think Europe could do better, and I certainly want to have an allocation there. That I think it's these allocations that allow you to stay in long-term assets, while even at a time when U.S. growth equities are looking a little toppy.
So what sectors, I mean, is your view the same as let's talk about JP Morgan, I guess, generally speaking. What sectors are you guys favoring now?
Well, I think I think it's not so much personally, it's not so much a sector as a style thing. I think this is a good time to think about value rather than growth, and add a little bit there. I think financials could do well. I think healthcare, I have some worries, again, depending on how much the current administration cuts back on government spending that flows through to to the healthcare industry in general. I think consumer discretionary should do very well because of the wealth effect for upper income consumers. Consumer staples maybe less so because of restrictions of population growth due to immigration. And then I think just utilities, I think should be I think look decently valued. So I think there are plenty of sort of boring opportunities. But I think I'd much rather look at it from a value versus growth perspective than picking out the sector. And then generally speaking, international, I think that there are opportunities in Europe and in Japan, maybe in China in the long run. But I wouldn't have much of an allocation there until I feel better about their long term story.
Guys, I have one more question before we finish in 7 minutes here, and it's more of a question that we financial advisors get a lot from some clients, investors, and it's a debt. So the 37 trillion in debt that we have today and growing. There are economists out there that have been talking about modern monetary theory or other concepts. Where do you sit on the debt situation, and how big of a potential problem is it, or is it currently?
Well, I think it's a problem. I don't think it's a near-term crisis yet. But a lot of people have been. It's one of those areas where people have been crying wolf for so long that this is going to cause a big blow up that eventually people say, well, it doesn't matter at all. And I wouldn't say it doesn't matter at all. We're running a deficit this year of about $2 trillion. Even if we don't extend the tax cuts of 2017, I think we will extend them. That should go up to about $3 trillion by the middle of the next decade. If we do extend all those tax cuts, it'll go up to at least $4 trillion. So I think, the deficit itself is going to rise. The debt is going to rise. I think we can still get away with a lot for a long time because people still trust the U.S. government to pay on its debt. And there's still a huge population around the world who needs an asset to invest in. So I don't think there's a near-term crisis unless people lose trust to the federal government. And I think that, that brings up two potential issues we've got to think about this year. One is we need to extend or eliminate the debt ceiling, and that's going to come up over the summer. And I think Mike Johnson in the House of Representatives is going to have a tricky time negotiating that one through. But we've got to raise, or my dream is that we just eliminate the stupid debt ceiling because it just distracts people from the actual business of balancing the budget. But that's one issue. And another issue is Fed independence. It's very important that whether the administration likes or dislikes what the Federal Reserve is doing, they don't try and strong arm them or don't try to replace personnel there. This one they're going to have to take as given, because the moment we have a central bank that is entirely subservient to a federal government that wants to spend like a drunken sailor, then you're going to have a real problem. So I think that Fed independence is important. I think when you've got this much debt, trust becomes more important. And so I think we've got to, that's where my concern really is.
Go ahead, Jim.
No, I was just going to ask you, David, about because you mentioned styles, growth versus value. How about stocks versus bonds? Bonds have not done well when we
Yeah.
look over the last 10 years. It's been tough.
Yeah.
And yet, high yield spreads are tight. So, we talk to our friends over at PIMCO, and they love most bonds.
Mm-hmm.
How do you look at it? How do you look at it if it's a 60-40 portfolio? Do you remove some of the traditional bond and put more private credit? I'm just curious what your thinking is just generally with asset allocation.
Yeah, I feel pretty good about the bond market right now. And that's something I couldn't have said for most of my career. For most of my career, I felt that interest rates were just too low. I mean, for most of the century, interest rates have been too low relative to inflation. That's not the case anymore. I mean, I think bonds, I have a normal allocation to fixed income as part of a portfolio. I have no problem with a 60-40 concept. In terms of, I wouldn't necessarily be overweight equities relative to bonds right now. But you're quite right. I do think that people ought to diversify into alternatives, and I think that's a big growth area. So things like infrastructure, real estate, transportation, perhaps private credit, but all of these, if you're going to put them into a portfolio to offset fixed income, you've got to have a good manager. Because what we see in the alternative space is just a huge divergence in performance between good managers and bad managers. So you've got to have the right manager. But yes,
Sure.
I think the alternatives can fill in for both, in generating income, generating diversification, and generating higher total returns for portfolios. So I think people need a more sophisticated approach, a broader diversification. But it's not really because you want to have less bonds, more equity. It's just you want to have more dispersion overall, or more dispersion in your portfolios.
Tally, you have one final question for Dr. Kelly?
No, it wouldn't fit in 2 minutes anyways.
Listen, I think that the conversation today was amazing. You answered a few tough questions that we had that's not typical, so we appreciate that. All three of us have a lot of respect for you, and so we appreciate you coming on our podcast and enriching the listeners and people that are watching. So thank you very much, and God bless you, and go JP Morgan.
Come and dance on our floor. Take a step that is new.